Hi, I'm Hamish Pepper, fixed income and currency strategist here at Harbour Asset Management, and today I'm joined by Oivan Reimer. Why is Oivan with me? Because we're going to talk about China. There's been lots going on there, a lot of change this year already. You are the equity analyst in the equity team who's covering those sectors that are most exposed to China. Let's start out with what exactly is going on.
Earlier in the year, we were really quite excited about seeing China come out of COVID. There was a lot of euphoria and there was a lot of sort of revenge spending happening that we've seen in other economies. But back in sort of April, May, it was becoming more and more obvious that China was about to run out of puff in terms of the consumer getting out there and spending up large. So we really needed to get boots on the ground to fully understand what is shaping sentiment amongst the Chinese consumers and what does that look going forward. And I think it's really important right now to understand that there's two big forces at play. There's a cyclical economy that tends to go in business cycles, and part of that will recover in time. We just don't know exactly how and when and how much stimulus might be required to get out of this cyclical trough. But then the other thing that was so obvious now was that the structural forces of the Chinese economy are being thought about much more so than previously amongst Chinese households. Demographic in particular is weighing on sentiment as the population is now officially in decline after having multiple decades of strong population growth that's come to an end. And it will have implications for consumption and investments going forward.
What you've described there is a pretty challenging kind of outlook for a country like New Zealand, whose largest trading partner is China, where you have a combination of cyclical slowdown in amongst this long-term sort of structural pressure. But how do you think about the way that China is going to impact our economy and our economic outlook?
It's a really good question, and it's one that we spend a lot of time trying to understand. It's particularly obvious right now is the impact that the lack of consumption in China is having on New Zealand's agricultural economy, where we're seeing less meat, less dairy, less fruit and other product from our ag economy not being in as hot demand as it has been previously, and we've seen prices come off quite a lot for most of our agricultural commodities and logs as well. So that is the real big one, where we can see the effect straight away. The other ones are obviously tourism and education being two really important sectors where Chinese citizens have had a meaningful impact on the demand for New Zealand education and tourism. That is not fully back to where it was pre-COVID. In fact, it's lagging quite a lot still. And whilst we're hopeful that at some point it's going to come back, right now there is no real indicator suggesting it's about to get back to pre-COVID levels.
And of course, from my point of view, the impact that has on our external vulnerabilities is massive. We have this big current account deficit. We're trying to get it back to somewhere that looks a bit more reasonable, look more like a bit like it has historically. And this sort of slowing in China through the channels you describe is something that's going to mean that takes time. That has implications which we've spoke about and published on, the most important of which is that perhaps the New Zealand dollar is going to be this sort of mechanism through which some kind of buffer or some kind of rebalancing can occur in a quicker fashion. When you tell me that kind of story for China, I think about something like our current account deficit and our external vulnerabilities. And I do wonder just how quickly we're going to be able to recover in that current account balance back to something that is more palatable for international investors. Now, speaking of this sort of markets angle to things, should we segue into what all of this story means for portfolios? What are we doing in equity portfolios, for example, as a result of this evolving Chinese situation?
Yeah, no, absolutely. And I think it's really important to appreciate that there are parts of the Chinese economy that we think have significant runway to grow still. Some sectors in China have competitive advantages relative to other countries that it's going to take a long time to catch up for the rest of the world, including green energy, batteries, and some emerging technologies. And we are wanting exposure to those sectors, as opposed to what we used to do in the past, was to buy companies and sectors that were exposed to the more sort of general health of the Chinese economy, be it through steel demand, property, or general consumption, which we now do not own a lot of. So those are sort of the type of moves we made in the portfolios and some of the changes over the sort of last 12 months.
And in the case of fixed income, I guess we don't quite have the same luxury to be as specific over the kind of exposures that we would want to have. So we just step it up to the high level macro view. A slowing China is something that is negative for New Zealand as our largest trading partner. Ultimately, what that feeds into is our thinking about the front end of our yield curve, where essentially monetary policy is assumed to be tight forever. And we say, well, here's another reason why that's unlikely to be the case. So it helps to inform our view that we are overweight duration in that part of the curve out to about 7 years, expecting with time those interest rates to come a lot lower than what markets are implying right now. I think what we've tried to put forward today is that we've got a challenging situation in China, which has these elements of a cycle, an economic cycle in them, but these longer term challenges which will play out over decades. Both of these things have implications for New Zealand, they have implications for the world as well. But what we're trying to do in portfolios on both the equity side as well as fixed income, and to be honest, as well as in the multi-asset space, is try to ensure that we navigate as best we can these challenges.